Hi folks, welcome to a video that's based on a question in your textbook, and you should have your textbook with you. We're going to be doing the problem that I indicated on your question paper for the review. So this is the second question, and it looks at share dividends as well as cash dividends, share retirement, and preparing a statement of changes in equity. So if you have a look at the question, it does say that we have some preferred shares that are cumulative, and there's no balance in the preferred share account at this time. So what that means is that nobody's bought those preferred shares yet. So we're authorized to issue an unlimited number of preferred shares, but nobody's bought them yet. We also have common shares, 200,000 or 20,000 issued and outstanding, and we have people giving us for those 20,000 shares a total of $552,000, and then we have retained earnings at $324,000, and this is at the end of 2013. Now they give us some transactions that happened in 2014 that deal with dividends, share retirement, and they want us to prepare all the transaction journal entries as well as a statement of changes in equity. So before we can do the statement, we need to make our journal entries. So if you look at the first journal entry in the question, we know that we're retiring 2,000 common shares at $36 a share. Well, don't forget, we may be retiring those 20,000 shares at I should say 2,000 common shares at $36 a share. That means that we're going to pay out for those, to buy back those 2,000 shares from investors at $36 each, $72,000. But we're going to remove the common shares from our accounts based on the average issue price. So we know that in total we have 20,000 shares that are common, issued and outstanding, and in return for those 20,000 shares, investors gave us $552,000. So we know that on average, people gave us less at $27.60 than we gave them back when we bought them back, because we gave them $36. So what that means is that while we debit the common share account for $55,200, which is the average issue price times the number of shares we're retiring, we know that because it cost us more at $36 to buy them back than what investors gave us is $27.60, we have a loss of some kind. But we don't call it a loss because loss is related to income. It has to be an equity account. So we debit retained earnings. It's an equity account. Notice in this particular question, we didn't have in our opening balance any contributed capital on common share retirement. If we did, we would have debited that account first before we debited retained earnings. But because we don't, we have to debit the balance to retained earnings. And to balance the entry, we need $16,800. So that's what we call your plug, or what we need to balance the debit side to the credit side. Now, if you look at January 14th, now it says that the directors declared a 10% share dividend that they're going to distribute on February the 5th. Now, it says the shares were trading at $45.60. So when we record the share dividend, we're going to record it based on the market price at the declaration date. The declaration date is January the 14th. So the first thing we need to figure out is, how many shares are we going to be issuing as a result of the share dividend? Well, we know that after we bought back or retired these 2,000 shares, we have 20,000 that we had at the beginning, less 2,000 means we've got 18,000 shares that are left, right? So now we're issuing 10% of those shares in addition to the 18,000 we have, which means an additional 1,800 shares, and we're going to issue them at the declaration date price of $45.60. So that means we're going to debit our share dividends, or because they didn't tell you to use a dividend, well, actually at the end they told you to close the dividends account, so I guess we needed to know that we were going to use a dividends declared, or in this case specifically a share dividend account, and we're going to credit an account called common share dividend distributable. Now we're we're using the distributable account here, don't forget, it's not a liability. It's a shareholders' equity account. But we're not crediting common shares. We're crediting this distributable account because we're not going to issue the shares until February the 5th. So we have to set them up in this common share dividend distributable account, which is a shareholders' equity account, for the amount of 1,800 new shares times $45.60 a share, which is going to give us $82,080. On January the 30th, we know that's the date of record regarding the 10% share dividend, and that just tells us whoever is holding the shares on that date is going to hold 10% more shares, but there's no financial transaction at the date of record, so that's why here at January 30th, you'll see that we have no entry. On February the 5th, well, don't forget, February the 5th is the actual date that we issue the shares from the share dividend. So we're going to debit our distributable account and we're going to credit common shares because we're actually distributing or issuing the common shares for $82,080. On July the 6th, quite simply, all we did is we sold 5,000 preferred shares at $60 a share. So 5,000 times $60 a share is going to give us how much? 300,000 as new equity. So we're going to debit cash because that's what the investors gave us for these 5,000 shares, 300,000, and we're going to credit preferred shares. On September the 5th, now we have a cash dividend declared, but the cash dividend is for 48,000. So now, if we're only going to be giving out 48,000, who's going to get what? Well, first of all, we know that the preferred shareholders get paid first, and their dividend is stated in the equity section as $3.60. Well, don't forget, in the transaction on July 5th, that's when we issued our first amount of preferred shares, and that means that we are going to pay out in terms of a cash dividend $18,000, $3.60 a share, okay, for 5,000 shares to preferred shareholders. So the preferred shareholders would get 18,000. So that means to balance, the common shareholders get 30,000. Because if we're issuing a cash dividend of 48,000 and we know that preferreds are going to get 18, right? Then that means the common are going to get the balance of 30,000. So now don't forget, it says here in the question that they're not going to pay the cash dividend until October the 5th. So what we need to do is debit the cash dividends or debit cash dividends declared account for 48,000, and we're going to credit the preferred share dividends payable and the common share dividends payable for the amounts that we calculated over here. Oh, you know what I just realized? You guys can't see that, can you? Again, see if I can, I don't know, it's not going to show up. But anyway, you probably couldn't see what I was typing in on the right-hand side there, but you do realize that as a result of July the 6th transaction, we issued 5,000 shares. The equity section, when we started the year, told us we were paying a dividend of $3.60 a share, which gave us 18,000. So to balance, we're issuing common shareholders a dividend at a later date of 30,000. Hopefully that makes sense to you, given that I had to backtrack a bit. Now on October the 5th, that's when we're paying out the dividends, so we're going to reduce the liability accounts and credit cash for 48,000. The other thing we realize now is at the end of the year, they told us on December the 31st that the income summary account was closed and it had a credit balance of $465,600. So when the income summary has a credit balance, what does that mean? It means you made profit. So we're going to debit it to close out the income summary and credit or increase retained earnings to record income or profit for $465,600. Now you also have to remember to close out all your dividend accounts. Don't forget, you have two dividend accounts. You have the share dividend account that you set up way back over here on January the 14th for $82,080. And then you also have the cash dividend account on September the 5th for $48,000. So we're going to close both of those share dividend and cash dividend declared accounts, by crediting them because they were debited before when we declared the dividend, and we're going to debit or reduce retained earnings by the total of that. So now, to do the statement of changes in equity, we're going to start with what? We're going to start with all of our opening balances for all of these accounts. These opening balances came from the question. We didn't have anything to start 2014, i.e. the end of 2013 for preferred shares. The question told us we had $552,000 in common and $324,000 in retained earnings. So we have total equity to start 2014 of $876,000. Now, preferred shares, we do know that back on July the 6th, we issued preferred shares for $300,000. So that not only increases our preferred share account, but on the balance sheet it increases equity by $300,000. We also know that we retired common shares, and when we did that, you'll remember back in our first entry on January the 1st, we reduced our common share account, reduced our retained earnings, and these are both equity accounts. So what happened? Well, again, go to common shares, reduce them by 55.2 and reduce retained earnings, meaning that we had a total reduction in retained earnings when we debited those two accounts back on January the 1st of $72,000. Now, they also said here in the question, to finish off your statement of changes in equity, that we declared dividends, right? Now, when we declared the dividends, later on in the year, we also issued them. So you'll notice here that what we have is we have common share dividends reducing, that's your share dividend, reducing retained earnings by $82,080. So that $82,080 is part of this debit that goes here, because here is where you close the share dividend. So if you credit it to close it, you're reducing retained earnings. So in this $130,080 is that $82,080. So retained earnings went down by that much, and then later in the year we issued the shares. We also declared cash dividends on the preferred shares, which were $18,000, and on the common, which were $30,000. We also increased retained earnings. You can remember up here, right, when we credited retained earnings when we closed the income summary account, which showed a profit, or a credit in the income summary account at net, which means we made a profit. So when we close out the income summary, we're going to increase the retained earnings. So we've got that increase right there. So now, if you add down the total equity column, you're going to get $1,512,060, and you're also going to see here that when you add across, right, when you add your preferred share, common share, and retained earnings columns, when you add across, you're going to see that you have total equity of the same amount, $1,512,600. Now, the question also asked you to come up with the average issue price per common share. I added that part in the question for you. You'll notice on the review sheet with the questions, I added this part. So in order to calculate the average issue price per common share, you have to take the ending balance in your common share account, which you can get from your statement of changes in equity as $578,880, and divide it by the number of common shares that are issued and outstanding, which happens to be 19,800. So how did we get that $19,800, you might ask? Well, don't forget, we started off 2014 with 20,000 shares, but don't forget, on January 1st, we bought back and retired 2,000 of them, so we only had 18,000 after the retirement. But don't forget, on February the 5th, we issued a share dividend, and as part of that share issuance, we issued 1,800 new shares. So 20,000 shares to start, less the two we retired, plus 1,800 new ones issued, is going to give us a total number of common shares issued and outstanding at the end of 2014 of $19,800. So that's going to give us $29.24 per share. So I hope you found this video helpful. Do go back to your textbook and have a look at the question. Again, the question is very clearly labeled what it is on your midterm review question sheet. So hopefully you've been able to find that, and thank you for listening.